I should not be easy market to call in the short term. I think that's for sure. There are just too many moving parts, and if you align all the moving parts right now, it is evident that in the near term there are multiple challenges which you will have to deal with. So the market environment is sticky. The market environment is perhaps one of those environments where you want to buy but you're waiting for the right price. Now the difference between a corrective phase and a crash is that crash is when there is compulsive unwinding, crash is when you're selling before you're thinking, but this is not a phase where we are bracing ourselves for any kind of a crash. I guess in the near term there were excesses in the market which got cleaned out. In the small and the mid cap space, I think that really seems to be the clear factor which is at play. Globally, one looks at the market, it is evident that the commitment levels have started coming down. The FI positioning in the cash market is reminiscent of how the underlying bearish mood of the market is. So the way I see the construct of the market, Aisha, is that upside is surely capped, downside is limited. Large cap stocks are looking extremely oversold if you look at from the FI lens, so they are due for a bounce. Small and mid cap stocks which were going up as a category in terms of in general approach, you were talking about, okay, small caps are going up, mid caps are going up. Now the narrative could be within small and mid cap stocks, individual stocks in a sense needs to be reassessed. This market has shaken a lot of weak traders, which is good. It has made everybody believe that nothing goes in the straight line, which is also in healthy and good. So I don't see too many fault lines in the market. In my book, bad days, you should be a buyer. In my book, this is a time when if you are sitting on some cash, maybe later this week or early next week, even in individual stocks and small and mid cap stocks, I think you will get a good entry point. I mean, 6 months from now, if we will look at October 2023, I think that would be called as the best buying opportunity of the year.
Yeah, absolutely. But one can't be in a rush to buy this fall, Nikunj, because, looking at the global handover this morning, there is very well a likelihood that we could test last week's lows, that was of 18,850 thereabouts.
That may well happen, Aisha, but if that happens, then you must look at the underlying fabric of the market. Will that get challenged? I mean, will Nifty go down in a linear manner? Looks unlikely because there is liquidity on the sidelines. The FI positioning is extremely oversold. The market conditions are extremely oversold. So a little bit of turn in the global market could actually inject some degree of short covering. Valuations are not that stretched that it really warrants any kind of sharp adjustment. So I'm not really worried about the construct of the market. Yes, in the near term, the momentum has got challenged, but that's the way it is. B, globally also, Aisha, if you look at it, you've not seen any kind of a linear decline. Currency market is intact. Nothing new has come from the bond market. We've seen routine profit booking in major markets and especially emerging markets. So 2%, 3% here or there, another 2-3%. That after $1 billion 2023 should be considered par for course. So if you're hunting for some margin of safety, I would stick my neck out as I've been doing. Stay with banks. If you're looking for a pocket where I think there are excesses in the market, I would still say that is in some of the pet themes, railways, defense and power. If you're looking for medium-term opportunity, I think pharma is looking exciting, especially looking at the kind of indications and numbers we've got. And if somebody is looking at constructing the portfolio, I think there are a lot of options in some of the new age or perhaps EMS or perhaps some of the manufacturing space where on bad days you want to be a buyer rather than running for cover.
Just taking stock as well as to how things have transpired across the globe, and you had the S&P 500 actually entering that correction zone, which is perhaps the point that Aisha was alluding to. The fact that we did see the US indices wrap up the week at least with a cut of nearly 2%. So that was Friday's move, with the Dow Jones cracking close to 1% or so. Remember, the dollar index as well continues to remain elevated. We'll be closely watching out for the FOMC meeting. Yields as well continue to rise as the core PCE is up about 0.3% on year. Gold is past about $2,000, and oil continues to be on the brink as you've got the geopolitical risks that continue, so nearing $90 a barrel. But that being said, Nikunj, we've been bombarded with a whole host of numbers, the likes of Dr. Reddy, Cipla, BPCL, Bajaj Finserv, this week as well as critical. And I guess Reliance Industries is going to be the big talking point too.
Okay, so Reliance numbers are absolutely in line. If you look at even the verticals, marginal miss and a marginal beat. Net, the numbers are absolutely in line with the estimates. Nothing new has come out, not that market was expecting anything new or grand. So these numbers are unlikely to change the trajectory for Reliance, which is that Reliance is unlikely to suddenly emerge from an underperforming zone to an outperforming zone. These numbers are not going to do that kind of magic for for the numbers per se. The other number which I think pharma is in my book, I think is standing out, whether I look at Cipla or Dr. Reddy. I mean, the margin expansion, the kind of indications what we're getting in the US market, the numbers what we got from Taro and then from Cipla and from DRL, those numbers are pointing that things for the pharma space is perhaps bottoming out and it's moving in the right direction. Then you've got Bajaj Finserv, and you've got numbers which have come from IDFC Bank, and those are good numbers. Frankly, they just tell you that the financial space per se, I think, is moving from a the growth phase is just not over. So banks really outperforming. Reliance numbers stable, in line, but they will not excite the market. I quite like what IDFC Bank has done. ET now is coming live from the headquarters of from the corporate office of India's biggest hotel company, which is IHCL. I think those numbers, even though they came during the market, are I think it is still encouraging to see the cycle uptrend continues. So it's about picking the spots right now, Avan. Excepting banks, I think in general the numbers have been in line. So which may not really warrant a major uptick per se. But Avan, banks are such a large part of the market that 30-35% of the market, if it is giving you signs of growth, and that gives you this comfort in the market that if banks are doing well and if they're growing without NPAs, that means the bare construct of the market, the consumer, the appetite to borrow and the appetite to pay back, I think that is intact. And for me, that I think is the bigger message.
Absolutely. Well, if you thought last week was hectic when it came to earnings, it's another 14.5% of the index weightage waiting to report its numbers this week too. And you've got the big boys, Nikunj. You've got Tata Motors, Tata Steel, Adani Enterprises, Bharti, and then of course the biggest of them all, L&T, with nearly a 4% weightage on the index.
Aisha, Tata Motors numbers would be crucial, and especially given that how the stock has been a ranked outperformer, and hopefully we will get some clarity as to the net debt plan what they had given to of becoming net debt free by 2025. Are they likely to prepone it? Because the cash flow what JLR is now generating, I think is absolutely amazing. L&T, well, even though stock has been a ranked outperformer, that now becomes like this. Now that is now really the cult stock of the market, so to speak, in terms of where markets are excited about in terms of the positioning of the stock. So yeah, these are two numbers, Aisha, which I think would be crucial. Like I said, that numbers are so far minus banks in line with estimates. They will not excite minus financials. The numbers will not excite a big earnings upgrade. So that really makes this market then in a sense exposed to the fact that in the near term the more weightage actually will come from global cues, liquidity, momentum, not so much so from the earning push. If I keep IT and if I keep pharma and banks on one side, rest of the earnings season has been in line, where IT has been dull, FMCG has been just about okay, and the rest of the gang, consumer names and all, have just given numbers which are in line with numbers. The good news, Aisha, is that we've not had too many companies which have really missed the mark by a margin, because at this kind of an level, if you miss the estimate and if you miss the number by just a whisker or by 5-7%, then there is no space to hide. So thankfully, touch wood, we've not had a result casualty so far from any heavyweight.
All right, fair enough. That's the view coming in on the overall earnings season too.